Hey everyone, let's talk about a name that's probably in your shoe rack right now, Relaxo. I mean, who hasn't owned a pair of Sparks or Bahama slippers, right? They are, without a doubt, a giant in the footwear world. But something's up. This giant seems to be under siege. And boom, this is the first big clue. We're talking a drop of almost 47% from its 52-week high. That is a huge fall. For a brand we all know and trust, a number like that just screams trouble. You know something's not right under the hood. So you gotta ask, right? What in the world happened here? How does a company that's practically a household name, a leader in its field, end up in this kind of mess? Well, that's exactly what we're gonna dig into. Let's get to the bottom of it. All right, first things first. Let's get a handle on where things stand right now. We need to see what this giant looks like today, now that it's clearly hit a bit of a rough patch. Just to set the stage, let's remember how massive Relaxo really is. You've got Sparks, their athletic brand that's just blowing up. Then there's Flight, which pretty much owns the slipper market. And of course, the classic Bahamas. We're talking about a company that sells somewhere between 15 to 19 crore pairs of footwear a year. I mean, that is just a mind-boggling scale of operation. Okay, so here's where things get interesting. The stock price is in the basement, right? But if you peek at their balance sheet, the company's financials are built like an absolute fortress. It's a total paradox. Let me show you what I mean. Check this out, a debt-to-equity ratio of just 0.10x. What does that mean in plain English? It means Relaxo is practically debt-free. They don't have a mountain of loans hanging over their head, which is an incredible position of strength, especially when the economy gets shaky. And it doesn't stop there. Get this. The company is actually net cash positive. So if you take all the cash they have on hand and subtract the little debt they do have, they've still got a cool 130 crore rupees just sitting there. That's not just strong, that's rock solid. And to top it all off, let's talk about their sheer manufacturing power. They can churn out 10 lakh pairs of footwear. Not a year, not a month, every single day. That kind of scale is a massive moat. It gives them a huge advantage that smaller players just can't compete with. See, a fortress. So this brings us back to our big question. If the balance sheet is a fortress, why is the stock getting hammered? Well, the cracks start to show when you look at how much money they're actually making. The profit and loss statement, yeah, that tells a very different story. And here it is, the heart of the problem. Just look at the revenue numbers for the past few years. It's basically flatlined. They're not growing. But even worse, look at the profit, the PAT. It's dropped from 233 crores down to 170. So not only are they not selling more, they're making less money on what they do sell. That's the 1-2 punch right there. Now, this next chart really drives the point home. It shows probably the most critical issue right now. You see the ROCE, which is the return they get on their investments, is actually lower than their cost of capital, the WACC. Let me put that simply. For every rupee they're investing in the business, they're actually losing a little bit of value. Instead of creating wealth for shareholders, they're destroying it. And just in case those acronyms are a bit much, think of it like this. ROCE just measures how good a company is at turning money into more money. When that number drops below what it costs you to get that money in the first place, well, that's a huge red flag. It's like your investments are leaking. Okay, so now you see the battleground. On one side, you've got this financial fortress. On the other, a profit engine that's sputtering. And this is where the story gets really dramatic, because there are these huge forces pushing and pulling the company at the exact same time. So here's the tug of war. The tailwind, the good news, is massive. The government/GST on footwear from 12% all the way down to 5%. This is a potential game changer. It levels the playing field against all those smaller, unorganized competitors. But then there's the headwind. Right when things are tough, their CFO up and resigns, and they're shifting to this new co-CEO model. That's a ton of leadership uncertainty right when they need stability the most. So what do you make of all this? You've got a rock-solid foundation, but profits are hurting. A massive potential boost from the government, but question marks at the top. Is this a brilliant buying opportunity, or is it a classic value trap waiting to spring? Let's see what the final verdict is. Well, the analysis boils all of this down to one number, a 53 out of 100. And that number tells you everything, doesn't it? It's not a 90, but it's not a 20 either. It's right in the middle, which means this is absolutely not a simple buy or sell call. It's complicated. And that 53 translates into a pretty clear verdict. Watch, or if you already own it, hold. Basically, the message is, hey, There's something here, there's potential, but we haven't seen the proof yet. It's not time to jump in with fresh money. It's time to, well, wait and watch. I think this quote from the report sums it up perfectly. It's a fundamentally sound business in a cyclical operating trough. Let's translate that. Fundamentally sound means the company itself is good. It's strong. Cyclical operating trough is just a fancy way of saying it's in a temporary slump. So the million-dollar question is, how long is this slump going to last? So if you're going to be watching, what exactly should you be looking for? Here's your checklist for their next quarterly report. First, is revenue growth back? We need to see it pop back above 5%. Second, are the profit margins getting healthy again, back to that 13+% range? And the big one, are people buying more shoes? Is that volume recovering? If you start seeing yes to these questions, that's your sign that the fortress might finally be breaking the siege. Now, before we wrap up, a quick but important disclaimer. Please remember, this analysis is for educational and informational purposes only. I'm not a SEBI-registered research analyst or investment advisor. Investing always comes with risks, and the data I've shown is based on public info and my own notes. So please don't take this as a buy or sell recommendation. Always do your own research or talk to a registered professional before making any financial decisions. All right. If you found this deep dive helpful and you want to stay on top of more stress-free investing analysis like this, do me a favor and hit that subscribe button. And don't forget to press the little bell icon. That way you won't miss a thing. And finally, I really want to hear from you. Which Indian-listed company should I break down next? Drop the stock name in the comments section below, and it just might be the star of our next explainer. Thanks so much for watching, and as always, keep your investing stress-free.